Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is using T accounts. So first of all, a lot of students ask me, T accounts, Professor, we don't use it anymore in real life companies and so on. No one uses T accounts anymore. Yes, you are absolutely right. However, there is no better way to understand the debits and credits, assets, liabilities, equity, revenues, expenses than T account. For instance, I have decades of experience in our profession and I still use T accounts some days, sometimes to think better about accounting. So T account is especially combined with accounting equation are the two most important topics to learn accounting. If you don't know it, you will not learn accounting. So watch this video how many times you want. And by the way, the video about the accounting equation is in our video description. Oh, and guys, subscribe our channel. It is very important to us. And there is a Facebook page called Accounting Hub by Dr. Scarpin, the same name of our YouTube channel. Please like it. So, T accounts. What do we have? Accounting equation. Assets equal liability plus owner's equity or just equity. So we just draw a T here. That is why we call T account. Assets, they are on the left side. Liability and owner's equity, they are on the right side. What does it mean? First of all, what is accounts? A record summarizing all the information affect a single item in the accounting equation is known as an account. Cash is an account. Sales is an account. Accounts payable, an account. So all of these items, they are account. An account device used to analyze transactions is called a T account. And what debit and credit means? Debit. A lot of instructors, they talk a lot about what is debit, what is credit, and so on. But we can summarize in debit means an amount recorded on the left side of an account. Here, left side, debit. Credit, an amount recorded on the right side of an account. So, debit here, credit here. Left side debit, right side credit. We could also name it apples and oranges, or Vikings and Packers, or any name you want. But we call it debits and credit for at least 500 years. So, a lot of time here. And what do we do? Increases, decreases, and balance, and so on. In accounting, we never, remember that, we never record negative numbers. So if we don't record negative numbers, how do we decrease an account? With debits and credits. For assets on the left side of the accounting equation, remember here, asset, left side. So everything on the left side of the T account increases an asset. Everything on the right side decreases an asset. So increases on the left, decreases on the right. Liability and owner's capital or owner's equity. On the right side of the accounting equation, here guys, right side, credit side. So, increase on the right or credit side of account, decrease on the other side. So, assets, increase on debit, decrease on credit. Liability is the opposite. Increase on credit, decrease on debit, or decrease on the right side, decrease on the left side. And what is the normal balance? The side of the account that is increased is called the normal balance. So, normal balance of assets left or debit, normal balance of liability and owner's equity, right side or credit sides. So asset have normal debit balance, liability have normal credit balance, and the other side we call it the contra balance. So normal balance, debit increases asset, credit decreases asset. Liability, debit decreases liability, credit increases liability. Owners, the same, debit decreases, credit increases. And guys, if you remember, revenues and expenses, they are related to the owner's capital or owner's equity. So revenue increases our owner's equity, so it will be credit. Expenses decrease owner's capital, so it will be debit. Okay? So before the thank you, let's go to our Excel file, guys. T account. So what do we do here? What do we have here? 11 transactions. And first of all, what do we have? So we need to name all of these T accounts here. How do we name it? Using the chart of accounts. So the chart of accounts is a list of our accounts. We need to standardize the names of our accounts. And what are these numbers here? It is based on accounting softwares like QuickBooks or any other software. Instead of typing cash, petty cash, accounts receivable, it takes a lot of time, so we only type 110 for cash, 130 for accounts receivable, and so on. So usually, it's not all the time, but usually our softwares work with 100 level accounts, that's what we call. They are assets accounts. 200 liability, 300 equity, 400 revenue, 500 expenses. So we will work with these names for the Scarping Web Service, my fake company. And here we have the same 11 transactions for the accounting equation. So if you go back to the accounting equation video, I am explaining these numbers here. Okay, but it's very good for us to find this ending balance here, because the ending balance working with accounting equation must match the ending balance of the T accounts. So let's assume that first of all, no beginning balance. All of our beginning balance are nothing. Here, received cash from owner. So receiving cash, our first account is cash. As we can see here, cash. So we are increasing our cash. So equal $5,000 increasing cash. However, we are also increasing owner's equity. Let's find a good name here. Jorge Scarping, me, the owner of this company. Capital, the 310. So here, Jorge Scarping, capital. Also $5,000. And on Excel, you can start a formula with equal sign or plus sign. If you start with plus sign, Excel will type the equal for you. Okay, that is good. So debit, increasing asset. Credit, increasing owner's equity. So here, let's add some colors here. Let's see if we can find 11 colors. But okay. Transaction 2, paid cash for supplies. So cash, we already had the account here. So if we pay it, it is decreasing our cash. Decrease an asset, it is a credit. So we don't record less or negative 300. We credit cash. Supplies, let's go to chart of accounts. Supplies. And your instructor will always provide you a chart of accounts, or you can name it with the name you want, but usually they will provide you the chart of accounts. So also 300. Let's this light blue here, our second transaction. Paid cash for insurance. So again, cash, we are decreasing cash, so credit cash. Let's look at the chart of accounts. Prepaid insurance or insurance expense? That is a very tricky question. Prepaid insurance means I am paying it now and I will use the insurance for some period of time. Insurance expense, I am paying only the insurance now. This is not so clear, but let's consider here a prepaid insurance. So debit, it is an asset account because I have the right to use this insurance for some time. For here, usually 1 year. Let's some green one here, and we are good to go. Bought supplies on account from Canyon Office Supply. So supplies, we are purchasing, so we are adding here 250. Now on account, so it is a liability. Let's check one good liability. Accounts payable Canyon Office Supply. So here, accounts payable Canyon Office Supplies equal 250. Let's find a color here. This one, I have no idea what color it is. Not good on colors. Here we have our transaction 4. Transaction 5, paid cash. So if we are paying cash, decreasing cash, credit, 100. What we are paying? On account to Canyon Office Supply. So we are paying these guys here. So we are decreasing a liability. Let's come back here. Decreasing liability. It is a debit. And guys, every transaction must be or must contain at least one debit and one credit. So one left side, one right side. Because of the account equation, because it will not match. So one debit and one credit. Some gray here, gray here. Transaction 6, almost half. Received cash from sales. So receiving cash, increasing asset, it is a debit. What is a credit? Sales. Our revenue here, sales. And why it is credit? Because we are increasing our owner's equity. And here, revenue and expenses, we are taking it away from the owner's equity, because here we have two financial statements. By the way, we will have a video about financial statements soon. And depending on when you are watching here, we already have it in our playlist, so check it out. Balance sheet and income statement. They are two different financial statements. So we combine all of these income statement accounts and add it to the income summary here. We also have, or will have, a video about how to summarize income statement and transfer to income summary. So sales, this blue, this blue, this blue. Sold service on account, another sales on account. To whom? Main Street Service. So let's go to the chart of accounts. Accounts receivable, Main Street Service. So accounts receivable, Main Street Services. And a debit, because we are increasing this asset, because it's the right to receive money. So it is an asset. Some red, too red. Ooh. Better now. And better now here. And better now here. And pay the cash for communications bill. So paying cash, credit cash, 350. Communication bill, it is an expense. What do we have? Communication expense. So communication expense. And it is decreasing our equity. So it is also a debit. Okay, same colors. Equipment rent, pay cash. So paid cash, 550. And equipment rental expense. So equipment rental expense equal 550. $550 and $550. Almost ending. Received cash on account from Main Street Services. So we are receiving part of this money here, part of this $800. How much? $300. So we are receiving $300. $300. Whoops. We are crediting because we are decreasing the accounts receivable. So we are crediting accounts receivable. So some gray, some green. Sorry. Some green here. And last, Jorge Scarpe withdrew equity in form of cash. So we are withdrawing 1,000, so credit cash. And we have no accounts for this yet. Chart of accounting. Jorge Scarpe drawing. So here, Jorge Scarpe, that's me, drawing. Decreasing our owner's equity $1,000. Now, a lot of accounts here. The ending balance is just like these numbers. Only one number is the ending balance. No problem at all here. No problem at all. However, what happened here? We need to find our ending balance. So, okay, if we have only debits or only credits, we sum them. So we sum here 550 for supplies. For sales, equal sum. Sales. Okay. But the other ones here, accounts payable. Accounts payable is a liability. A liability, the normal balance is a credit. So it is a credit here. So equal credit less debit, 150. Accounts receivable is the opposite. Asset. The normal balance is on debit. So our debit less our credit. What about cash? A lot of numbers. However, cash is an asset. Normal balance is debit. So what do we do here? Equal sum. We are summing our debit less sum of our credits, because our credits decreases our asset. And here we go, $4,800. We can match these numbers with the accounting equation. 48 for cash, 500 for accounts receivable, we are good. 550 for supplies, we are good. 200 for prepaid insurance, we are good. 150 for accounts payable. We're good. And then capital, we combine all of our equities here, and here we split in two. So 5,000 and then revenues, expenses, and so on. But it's probably right. However, how can we for sure know it is balance? Look how cool it is. It is not in our textbooks. Okay? So, double check. How do we double check? We copy and paste all of our ending balances. So, copy and paste the first one, 4,800. The second one, 5,000. The third one, 550. The next one, 200. Later, credit again, 150. Credit again, 2,800. Debit now, 500. Oh, we need additional rows here. Debit 350. Debit 550. And debit 1,000. And now we find our total. So here it is our totals. Okay. How do we find the totals? We sum them. Sum. And again, sum. These numbers, guys, they don't mean anything at all. Okay? However, they must match. If they don't match, we have some problems. For instance, here they are not matching. If they are not matching, something is wrong. Let's double check. 48 cash, okay. 5,000 credit, capital, okay. 550 debit, okay. 200 credit, whoops, 200 is debit, not credit. So let's delete it here. Equal debit. Our double check was wrong. Let's double check again. Now we are absolutely good. Our numbers are matching. So our T accounts are good to go. Probably we are completely right here. So if this huge double check T account of your assignment, if it matches the left and the right side, probably you are right. Okay? So guys, that's it. Thank you so much. Questions, comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.